do with your structure. So with that being said, we'll get started here. And again, thank you for being here, and thank you for being persistent to get the link. And we're going to get going. So the first thing I want to share is that, first of all, I don't know if everyone on here understands what we do, or understands or knows everything that we do, because a lot of our clients, they come to us for one specific reason, or we may talk to them about one specific thing, but they don't realize that we offer a number of different strategies for building their business. And if you talk to me on a regular, you would know that my focus is always on the money. Like, what can we do to structure your entity to bring in more funds, to make your entity look more attractive, but most of all, make it to where it is protected and you are protected from creditors, and then those crazy people out there who like to sue people, So with that, we provide asset protection. And so I don't know if all of you knew that or not, but we do. We provide asset protection that will protect business assets from liabilities. We provide succession planning to ensure that a client will minimize capital gains when the client sells their interests during retirement. Let's say that you want to retire and you want to, either leave your business to your family or a family member or a partner or whomever. But we also provide the estate plans. Now, in estate planning, we don't actually do that. Of course, you need an attorney to do that. However, we have access to attorneys. So we actually have two different resources. We have access to an attorney for what we call trust, and we'll talk about that later on. But in general, estate planning, that includes your will and your living will and your power of attorney and all those kind of things. Those are important when you're talking about leaving a legacy for your family or for your kids. You can't leave a legacy if you don't protect your assets. So our legacy is to provide the client now, is to protect the client now, in the future, and even at death. So when we realize this, the result of what we decided to do is to merge tax and strategic asset protection. All right. So that should give you a little, beginning of what we do and why we do it. And the fact that, when we have conversations with a lot of you, and then we say, oh, well, we provide that as well. It's like, and then it's out of the realm of what you thought we did. So this is a general introduction of all of the things that we have access to. So we position ourselves to have these resources available for our clients. Now, the first thing I would like to say is, for our agenda is we're going to talk about the employee to business owner, the LLC to SCorp, the tax deductions, tax credits, tax strategies. Okay, these are the items that we're going to talk about. Now, in 2018, we delivered a total of 564 tax jobs. Hold on, let me let somebody in. Okay. Among these projects, some of the highlights were we successfully helped a client to avoid paying $643,625 in unnecessary taxes from an ill-advised corporate reorganization that also exposed the client to unnecessary judgment. Now, the reason why I say that is because, of course, that's a success story for us. It's also a success story for the client, but like I said before, introducing you to what we do and how we position our company to do it, we were very proud of the fact that we were able to save that client that much money. Like, I was just shocked myself just from restructuring that particular entity. The second thing, we had a client in Florida. We were helping a client in Florida. They were an auto supply company. They were an auto supply store, They saved over $78,000 annually with just a comprehensive entity structure that protects business assets from liabilities. Now, depending on the type of business that you have, depends on the assets that you acquire along the way, because the more you create in your business, the more assets you acquire. And also the more you purchase, the more assets you require. And the third story that we have is that we identified $45,000 in crucial tax savings that were missed for a construction company. Actually, the construction company was here in Houston that provided commercial millwork for schools and churches. So, so we're not new at this. We're kind of new. I guess you would say, if you say that we're like what, 5 years? How long is that? 18, 19, 20, 21, 21, 3 years ago. So 3 years ago, 2018 is actually when we opened our doors up for the tax side of the business. So in 2018 is when we had these stories that were just phenomenal. And so we kind of just bust out the gates with, some phenomenal stories in our first year of providing tax services. And because of that, we were able to leverage and to just bring on more resources and just keep adding on to it. All right, so now let's talk about employee to business owner. Now, a lot of people go from working a job to being a business owner. And in some cases, you may still be working your job. So this example is Samantha started her counseling business in 2020 during the pandemic. And I say pandemic because I believe it was planned. And the news has been kind of proof of that lately. I'm not going to talk about that. But after being laid off from her job in March 2020, she decided to put all of her efforts into starting and growing her very own counseling business. Her job required her to be a W-2 employee, but she saw another vision a long time ago to establish her own entity after she had created several counseling strategies that proved to have assisted her clients with her personal relationships. She researched on how to protect her intellectual property. By September, she had generated over $126,000 in revenue by innovating her services to a virtual format. Now, Samantha has a decision to make. Does she try to manage her business finances herself, or should she reach out to an expert to help guide her? Samantha realizes that making $50,000 as an employee is not the same as making $126,000 as a business owner. Now, some of you may already know why that's not the same. As an employee, the tax file, it's all about taxes. The tax filing that you're filing is a W-2, right? As an employee. As a business owner, that depends. You have more options of what you can file, but it's based on a ratio. It's based on a ratio of your of what you're bringing in as term of revenue, and then it also has to do with your assets. So you just really have to be evaluated, by an expert, I believe, a person who, like in my position, or an individual like on our team, who can actually identify what your assets are and how to protect them and what instruments to use to protect those assets. Now, Samantha's financial future. Now, this is the job versus the business. Okay. So on her job, she filled out a W-4 form when she was hired, right? Using her social security number. She filed a 1040 when she filed her tax return. She also will be taxed at a higher rate, almost 70% as a W-2 employee, and will owe federal taxes. Samantha got paid direct deposit from her employer. Okay, that's Samantha on her job. In her business, Samantha acquired a contract with a local company and filled out a W-9, right? She's filling out a W-9 instead of a W-4. And she's using her EIN instead of her social security number. Samantha filed the Schedule C attached to her 1040 when filing her tax return. And all business owners, when you file that Schedule C, I mean, that's the most beautiful thing that you could ever do for yourself. ever, especially starting out in business, because then, you can deduct all of the expenses that you incurred in starting your business and growing your business. Now, also, Samantha would be taxed as a self-employed individual. Now, I don't know if you knew the percentage, but as self-employed, you're taxed at 15.3%. And she will likely get a refund depending on her business expenses. It is not uncommon for you to get a refund when you file your taxes, when you file your 1040 Schedule C. It is very uncommon not to get a refund in my world, because when I hear people tell me like, well, I don't know, I owed, $6,000 in my taxes, but I had a business, I had expenses, and, and then, give me some other details right away. There's a red flag in my mind. I'm like, wait a minute, you should not be owing $6,000 in your taxes. What's going on? And so I was like, let me look at it. Let me take a look at it. So just know this, it is not uncommon to get a refund as a business owner. You should. The reason why is because especially the first 3 years, because your expenses will usually give you the deductions to offset your revenue. All right. Also, Samantha has to pay herself a salary. Now, this is the big difference. She has to pay herself. Most business owners, like I said before, when they started applying for that PPP, they were trying to figure out how to pay themselves because, it was the paycheck protection. It was only for the employees that you have in your business. And if you don't know how to pay yourself, right, hence the challenge that they had. So Samantha has to pay herself a salary. She purchases QuickBooks for a payroll system and then is positioned to direct deposit herself. She started out perfectly, right? Let's see. Samantha now has to manage her personal finances as well as her business finances. Now that's the kicker right here. When you have to manage your personal and your business, this is where most business owners fall short because they start mingling the personal and the business, which makes it very confusing for your tax preparer or your CPA. It also makes it confusing for you because that's why you're confused about, or, other business owners, not you, other business owners are confused about how to pay themselves because they're intermingling those finances. However, she knows that business finances work differently, so she hires an accountant. Now, in this scenario, of course, I chose to have Samantha, to give Samantha some wisdom. So that's why she's making all the right decisions because, it's leading to my point, right? All right, so she knows that business finances work differently, so she hires an accountant. Now, Samantha has support with her business finances, and her accountant has introduced her to the RP3 system to ensure she makes a profit each quarter. If you don't know about that, let me know if you want to know about that. Our RP3 system is an accounting system that will help you learn how to pay yourself, especially as an SCorp. And we'll talk about that in a few minutes. Now, your entity structure, your pros and cons. Now, the advantages and disadvantages of an SCorp, SCorp designation. Now, the reason why I chose these two as opposed to an LLC versus an SCorp is because I wanted to talk about, this is the only portion where I'm going to talk about the SCorp. Everything else I'll talk about the LLC versus the SCorp, but these are the advantages and disadvantages. Now, the SCorp is considered most people stay away from because it's considered a double taxation strategy. You will be taxed twice because you're taxed on it, under your personal and on the back end of your business. So that's why a lot of people stay away from it. However, it just depends on the nature of your business. So the advantages of an SCorp compared to a SCorp: the shareholders are allowed to withdraw from the corporation without increasing W-2 wages or issuing dividends. Now, who are the shareholders? You are the owners. Anyone who has invested funds, intellectual property, whatever, anything that adds value to the entity is a shareholder. There are shares that are usually distributed to the shareholders. Now, the advantage of the C Corp is that it's a flat federal income tax rate of 21%. Okay, now that's the advantage of a C Corp. The W-2 wages, of course, like we said earlier, when you're a W-2, you're taxed at a higher rate, right? So, but you don't have to increase your W-2. You can fiddle with the W-2 wages, back and forth from your personal and the corporation, okay? Personal assets are protected from the company's operations in the S Corp. Now we're going to talk about this because you can't pile up all your assets and you not protect them, even more than what they are. We'll talk about that. Also, S Corp advantage is exposure to net investment income tax, likely minimized during the sale of a company's stock. You usually don't get into selling your stock or selling of your shares unless you're really rocking and rolling and you have investors and you're issuing K1s on a quarterly and you're on a different playing field with your S Corp. Protection of personal assets from liabilities that may arise from company operations, right? That's the advantages of S Corp. The disadvantages of S Corp: certain levels of income are higher rates than a C corporation. Like I said, going back to the W-2 wages versus the 21% for the C Corp. Certain levels of income are higher than higher rates than a C Corp. And then the other disadvantage of an S Corp: shareholders who own more than 2% of the company are not allowed to utilize fringe benefits offered to employees. Now, what are fringe benefits? That means that you're going to give your employees, let's say, dental care for free. That's a fringe. That's a fringe benefit. That means that the employee is not going to pay for it, that you are going to pay for it, right? So, but most of us don't have that type of challenge. So if you look at these disadvantages, they really don't apply to a lot of small business owners unless, like I said before, that you're operating on another playing field when you start, issuing K1s, you have several investors and things of that sort. Now, let's talk about the disadvantages of setting up a C Corp. The disadvantages of a C Corp: in order to withdraw profits from the company, a shareholder must increase W-2 wages or issue dividends from the company. And I'm going to say that again. In order to withdraw profits from the company, a shareholder must increase W-2 wages. That's where the double taxation comes in, because you're being taxed on the W-2 wages. And in order to get your profits, you have to increase on the W-2. So you're paying more in W-2 taxes, but you're also paying on the other end with your dividends, right? So, and then also cannot utilize certain key deductions like the small business income tax maximized during the sale of the company stock. Okay, that's if you're selling your company, or because a lot of people do that. They start businesses, they create it, they build it up, and especially if you're into business credit, you can set up an LLC, build a business credit, sell it, get it valued first, of course, build it up, sell it, and do it again. I know several individuals here in Houston who did that years ago. I think it was like 2011. That's when the light bulb really went off, when I was really getting into structuring businesses. So these are just some of the disadvantages and advantages of S Corp. And so like I said, this is the only slide that I'll talk about C Corps, because really most business owners like yourself are really not focused on C Corps. We're talking about S Corp. And then of course, this is the S Corp playbook. But I definitely had to put this in here to give you that information so that you will understand C Corps versus S Corp. Now, where your 2019 tax dollar went. Here's the kicker here. This chart shows how each one of your income tax dollars was spent by the federal government in the year 2019. You get your personalized tax receipt or see an advantage, average tax for your state or whatever. Now, federal income taxes pay for everything from the military to education, from federal prisons to cancer research. There are other federal taxes you probably pay too, like Social Security and Medicare taxes, right? But only income taxes are included in the tax dollar. So for every dollar that you make, and this is what your tax looks like. This is how the dollar is broken down, right? Okay, so remember that dollar. Don't forget that dollar. Now let's talk about the structuring and the pros and cons of the entity structuring. All clients need a comprehensive entity structure to take advantage of all parts of the code. And the code that I'm talking about is the tax code, right? Because like earlier I said, everything really, when it comes to entity structuring, it's all about taxes. I see a lot of people online, you know, especially in these nonprofit groups that I'm in, they're always saying, you know, I need someone to help me set up my tax exemption, or I need someone to help me set up my LLC. And somebody will say, oh, you can do it yourself, or, you know, or you could do this. There was another question somebody asked about asset. It was something in regards to asset protection. I was just very impressed because I hadn't been used to seeing such a detailed question. It's just usually general. But the most important thing to understand about entity structure, when whatever decision that you make to file your entity under, that's a tax decision that you're making. So every entity, what you're doing, you're telling the government, this is how I want to be taxed. I'm going to set up an LLC. Now I'm going to, when I file my taxes, I'm going to tell the government, matter of fact, when I file my entity rather, I'm telling the government, I want to be taxed as an LLC or sole member LLC or whatever type of LLC that you set up. Or I'm telling the government, I want to be taxed as a corporation. And then I would designate what type of corporation I want to be taxed as. Now, like I said, you definitely have to get advice from someone who really and truly understands corporations, because if you make a decision to be taxed as a corporation, you have to make sure that you understand what type of corporation you should be taxed at based on your business type. Also based on your industry, based on your operations, based on your revenue, based on your assets. All right. So these are two, these are disadvantages and advantages of, and pros and cons also, you know, of your entity structure. For sole proprietors report business operations on Schedule C. The Schedule C is missing, of their personal tax return, and they have one tax return, right? Also, general partnerships do this too. Disadvantages, excuse me, the disadvantages of sole proprietor and general partnerships: personal assets are subject to liabilities that may arise from the company's operations. Earnings from the company are subject to self-employment tax. Remember that 15.3%, that self-employment tax rate. Owners are not allowed to take advantage of fringe benefits offered to their employee. We talked about that earlier. Passive partners are subject to the net investment income tax. Okay, so going back to what we were saying earlier, you know, I said that, you know, we compared what? SCorps and SCorps. Now we're talking about the disadvantages of sole proprietorships and general partnerships. Okay, so, but these are not saying that it's a bad choice. We're just saying that this is what you have to look forward to in terms of taxes, in terms of, okay, if I am a general partnership, you know, versus another type of partnership, which is a limited liability, right? Then I'm going to be subject to these advantages and these disadvantages. Okay, so that's what this one's about. All right, now let's finally get into the SCorp structure. What is an SCorp? An SCorp is a separate legal entity distinct from its owners, right? That's when you separate yourself from your business. Going back to what I said earlier about, people not knowing how to pay themselves, in order to separate yourself, most people go into the SCorp designation in order to have themselves as an employee, in order to issue themselves a W-2 at the beginning of the following year, right? This is the usual reason why most people file as an SCorp. Another usual reason is because of income. Well, not income, I would say revenue. Most tax or CPAs or tax preparers or accountants will tell you that if you get to $100,000 in revenue, you should change to an SCorp. The reason why is usually because of the ratio of expenses versus revenue. Now, while that is very true, that's not the only reason why you would change to SCorp, okay? It's widely used by small business owners to save money on taxes, but also provides a liability protection for its shareholders. SCorps have some limitations. The first limitation, you can only have one class of stock, right? The second limitation, not more than 100 shareholders. And some of these things you may say, I'm not really worried about having one class of stock because I don't even know what that means. Well, all the more reason, like I said, when you have a consultation with an individual, make sure that they understand how to explain that to you so that you will know for you and your business, because this is on a case-by-case basis as to whether that will make a difference in your business or not. Okay, so like I was saying, number 2, not more than 100 shareholders, right? Number 3, be a domestic corporation, which means that you need to be located in the, in the state. Domestic, and I pause here because domestic sometimes means within the state, sometimes foreign, depends on, what this part, I forgot what I was talking about with this, but I think what I was referring to was the domestic corporation within each state, because you're considered foreign. Like I'm in Houston, and if I filed for an LLC, which I did in Louisiana, and I don't have an address there, I'm considered a foreign corporation. Okay, so it could also mean that you're domestic within the states, right? Number 4, the shareholder must be either United States citizen or legal resident of the United States. Okay. Now, with the SCorp, we're going to explore the options, why you should choose the SCorp. Now, I am a fan of SCorps for small business owners. Now, like I said before, we're a business development firm, and our main focus is to help businesses build to capacity. And that has to do with structure, that has to do with funding, that has to do with anything that has to do with growth, right? So why you should choose an SCorp and when you should choose the SCorp. Let's explore this option. Your net profit from your business is $130K. Your self-employment tax on $130K. Net profit is $19,890, right? By electing to be taxed as an SCorp, a business does not pay 15.3. Remembering the 15.3% is the self-employment tax, which reflects your Schedule C, okay? That reflects your Schedule C. Instead, the net profit from an SCorp is passed through to its shareholders. Now, a lot of people know that, SCorp is a pass-through entity, but not really understanding what pass-through means. Pass-through means that you're going to pay yourself and only be taxed on what you pay yourself as opposed to the total revenue. So going back to the $130,000, let's look at our example here. Your net profit from your business is $130,000. You elect to be taxed as an SCorp and your salary is $70,000. Now your self-employment tax is now $710, saving you an estimate of $9,000. Now, hopefully you got that. And if not, I'm gonna repeat that part. Basically, when you elect to be an SCorp, you are not being taxed at 15.3% of the $130,000 anymore. You're being taxed at whatever your reasonable salary is, which in this case is $70,000. Therefore, again, you're saving $9,180. Okay, so I hope that makes sense. That part is the beauty of switching to SCorp from an LLC, you know, and of course that LLC is your Schedule C on your taxes. You definitely want to keep Uncle Sam out of your pocket as much as you possibly can. So our SCorp taxation. Now, when we're talking about taxes, the SCorp must file a separate income tax return. Most of you know this. Most of you are already SCorp. I think one or two of you are SCorps on here. We have other clients who have filed and we've done their 1120s. We did a lot of 1120s this year, but it does not pay its own taxes. Okay, now that's the thing. It does not pay its own taxes. Instead, here's a simple breakdown. All net profit from an SCorp is passed through to the shareholders via a K-1. Therefore, if you are an SCorp and your CPA files your taxes and you do not have a K-1, you need to make a phone call tomorrow morning. You should have a K-1, okay? The net profit reported on a K-1 for each shareholder is then reported on the shareholder's personal tax return, after which, and remember that $70,000, right? So it's reported on the shareholder's personal tax return, after which shareholder pays his or her share of taxes depending on his or her tax bracket on the income received from the SCorp. Okay. Now the SCorp is always required to file its taxes, even if you have no activity that year, because there's a penalty. You don't want to pay $195 per shareholder, and per shareholder is per, you know, usually in small business cases per owner. But if you have investors, you know, if you're in real estate and you have investors, you know, and you're paying investors on a quarterly basis from the profits, you know, it would be per shareholder in that case as well. SCorp tax return, which is the Form 1120S, must be filed by March 15th. When the 15th falls on a weekend, the return is due on the following business day. All right. So hopefully this kind of bridged in our last slide that was talking about the W-2, because the W-2 portion goes on your 1040. Your K-1 portion goes on your Schedule C. So what this looks like, you have an 1120 tax form for your entity, but you also still have to file your personal taxes, right? So on your personal taxes, you have the W-2, right? Your $70,000, and you have a K-1 that's on your Schedule C. In addition to filing your 1120 SCorp taxes for your entity. Okay, so hopefully that makes sense. There's three different aspects of reporting as far as your income is concerned. All right. Okay, so now owner salary strategy. Now let's talk about owner salary. I have a question before we talk about this. In the chat, I want you to answer this question. And this is just a yes or no question. So find the chat in your settings, and I want you to tell me, do you know how much your salary is supposed to be if you already are, or if you did become an SCorp? Do you know how much your salary would be? If you are already an SCorp or if you became an SCorp, would you know your salary? Put that in the chat. Okay, we have one no, we have one yes. Oh yeah, Miss Jackson, I figured you would. Hello, Miss Jackson. All right, yes, currently now, know my salary. Okay. All right, good deal. We have 3 people responded. Okay, good deal. Now, let me talk to you about your salary. Let me talk to you about that. Your owner's salary, there's a strategy. There is a strategy to your salary. There's something called reasonable compensation. And that, of course, when anything that has to do with taxes and, and when they say something like reasonable, there's a clear definition. It's just that the definition is so comprehensive that they just don't want to put it out there. They make you read and research for it, right? But as an owner of an SCorp and its officers, you are required by the IRS to pay yourself a reasonable compensation. All net profit from an SCorp flows through to its shareholders, and we talked about that. So hopefully we have an understanding of what the flow through means as far as flowing through to the shareholder, because the pay, or better yet, the taxes you're being taxed on your personal that you still have to file separate from your 1120s. Now, which means that all profit is not subject to self-employment tax, okay? Which means that self-employment tax, that's that 15.3%, which is Social Security and Medicare. What does reasonable compensation mean? Ironically, the IRS doesn't get into details of what reasonable compensation means, because it does say that a reasonable compensation is any salary that you would pay to a person doing your job in your position, or in some cases, not even, okay? My advice is there is a standard that you can look up. If you have not looked up salaries in your industry, doing what you do, that will be a very good thing for you to do, to look up the typical salaries of a person working in your business, having the title, and you may have to fumble around with your title a little bit in order to designate yourself as the W-2, but that reasonable compensation is typically within that range. In many instances, I've seen that owners of an SCorp overpay themselves a salary, which results in an overpayment of self-employment tax. If you overpay yourself, you're voluntarily saying, Uncle Sam, I want to give you more money this year because I just don't need it. So we don't want you to do that. We want to make sure that you have reasonable compensation and that it is specific to you and your industry. And, so you don't have to give so much back that you don't have to give, because, they're not going to give it back to you. They will correct your taxes and take money from you, but they're not going to correct your taxes and give money to you. All right. So if you give them too much, they're just going to take it. All right. By establishing a reasonable salary for yourself as an owner of your SCorp, you will significantly save money on self-employment taxes, which could mean thousands of dollars in taxes. Most business owners are wearing many hats in the business. Now, this is the part where we were talking about when we did the event the last 3 weeks, but we did it every week the last 3 weeks, when we were talking about the PPP that pays, the RP3 system that we developed here at JA. You wear so many hats in your business. You're the salesman, you're the admin, you're the bookkeeper, you're the invoicer, and then being an owner. All of these categories combined together will reduce your taxes significantly. Now, going back, like I was saying with the RP3 system, the RP3 system pairs with your tax designation or the filing of your taxes, because there is an owner's compensation portion where we create a strategy in your accounting system where you will see profits every quarter. Most CPAs and accountants, they show you profits at the end of the year when they're filing your taxes, right? Or whenever your fiscal year ends. With our RP3 system, you see your profits every quarter, because with that strategy, most people, especially if you're an LLC, you first start your business, your LLC, it's just you're providing services, whatever you're doing in your business, usually is you for a long period of time before you hire anyone else, unless it's your children, and we'll talk about that as well. Most of the times you do not have, you do not have employees, which means that you wear a lot of hats. Using the accounting system that we just went over the last 3 weeks, you also, not only do you see the profits every quarter, but you see the profits every quarter in the first year. Okay, so I just had to put a plug there because we have, we already have testimonies from using that system. If you are not seeing profits at the end of your fiscal year, or better yet, if you only see profits at the end of your fiscal year on paper, then you definitely need to talk to us, because we're not talking about seeing profits on paper on your financial statements. We're talking about seeing the profits in your bank account, and then maneuvering so that you can use those profits to either, grow your business, the goals and all of the activities that you have planned to grow your business, reinvesting in your business, paying yourself a bonus out of the profits. There's a whole different compensation that you should be getting as an owner. All right. Now, let's say that you hired your spouse. Overpaying your spouse's salary will cost you in overpayments of FICA taxes, because they're an employee, right? FICA taxes or your payroll, which are Social Security and Medicare taxes. How do you determine your spouse's salary? Well, think about it. If you are to hire someone else in his or her, okay, I put that wrong. If you were to hire someone else, how much would you pay that person?
Okay.
All you must do is pay your spouse a reasonable compensation, a compensation you would pay someone else doing the same job. You don't need to pay your spouse over $100,000 in salary, especially if your spouse has a day job. Now, reasonable means reasonable, but reasonable also, can someone mute your line? Reasonable also has a clear definition, and we'll go into that in a second, by the IRS, because I have a document that I'm going to send you where it talks about what's reasonable. All right. So compensation, when you're talking about hiring your spouse, don't hire your spouse and not give them a title. Don't hire your spouse and not give them a job description. That is that's a disaster, because then, there's a conflict in the duties, right? You don't want to have that argument. You save the arguments for real stuff, not the stuff that you can, mitigate up front. But for example, like if you hire your children, same thing. Make sure that they have a job description and make sure that they understand what their responsibilities are, so that you can find in your industry the reasonable compensation that you should be paying your spouse, or your family member, right? All right. How much to pay yourself? Now, $50,000 versus $40,000. And that's your officer compensation salary. Therefore, okay, $10,000 a shareholder salary costs you, a $10,000 shareholder salary costs you $1,530 in additional taxes beyond income tax, right? In a different way, if you pay yourself $50,000 when $40,000 could have been the reasonable shareholder salary, you just wasted $1,530. That's what I'm talking about when, you know, when it says reasonable compensation. It, you know, in theory is reasonable, subjectively is reasonable, but objectively you really need to look it up, you know, to see what's reasonable, because this is a small difference. The $10,000 difference, that's a small difference. That's an easy mistake to make. But as you make that mistake, you waste $1,530, right? The IRS revenue ruling 74-44 says that dividends being used to pay for services are truly wages, okay? If Google or Amazon pays out a dividend to its shareholders, it is considered investment income. Now, this goes back to the K1s, investment income. If your SCorp does the same thing to its only shareholder without an accompanying reasonable shareholder wage, then it is considered self-employment income and subject to taxes with that type of income. Of course, that's the 15.3% tax. All right. Now, this particular ruling has a fact sheet. There are several factors to consider when producing a reasonable shareholder salary. And guess what? I have the fact sheet, and I'm going to email it to every last one of you after this presentation, because I want you to, you know, I want you to take some things, take something with you so that you can review and learn a little bit more, because this portion of what we're getting into is the how to pay yourself can be very tricky. But as you read the fact sheet, and it's only about 2 pages, it's not that long. When you read the fact sheet, it will make so much sense, and you would understand what your accountant or your CPA is doing or is not doing. Or, you know, maybe sometimes you just need to have a conversation and bring this up. And the fact of the matter that it comes from the IRS is very credible. So I'll be sending out that fact sheet to you to make sure that you have that after this presentation. Now, in 1959, the IRS ruling held that amounts of SCorp undistributed taxable income, which are required to be included in each shareholder's gross income, do not constitute net earnings from self-employment to shareholders. All right. Now, that particular ruling, I will also be sending that out to you, as well as the 74-44. So the other ruling, if you're taking notes, was 59-221. And the ruling that I have here on the screen is 74-44. But I'll be sending those documents out to you after this presentation. All right. Now, reasonable shareholder salary. The factors to consider: your training and experience, right? So if you're trying to hire, it's tricky hiring a spouse, right? Because, and I know I don't have a spouse, but I used to, but I never hired him. But I know it is because I watch my clients. It is very, you know, it can be tricky hiring a spouse. It can be tricky hiring your children or any family member or even a friend, because now you have to evaluate them based on their training and experience. And then sometimes they look at you sideways like, what do you mean training and experience? I help you do this and I help you do that. You know, that's a whole nother conversation. Duties and responsibilities, right? Time and effort devoted to the business, dividend history. If you've paid dividends to this particular individual before, that's a factor that comes into play. Payments to non-shareholder employees, timing and manner of paying bonuses to key people. Key people means that if that person leaves the business is hurting in revenue. That's a key person, right? What comparable businesses pay for similar services? You want to make sure that, you know, you're managing your revenue, you're managing your expenses rather, not your revenue. You're managing your expenses based on what is comparable that other businesses are paying for, right? Compensation agreements, of course, you need to make sure that you just budgeting, the use of a formula to determine compensation. Now, all of these things, well, most of these things are usually done by someone who can financially plan with you, who can identify, pros and cons of structuring or hiring. Because sometimes you want to hire just to make yourself feel good. I was listening to an audio tape, and this individual said, I listened to a lot of business books, and he said that he hired a whole bunch of people, got a big, nice office, all because he knew he could, and it made him feel good. But the reality is he really didn't need it. He really didn't need the office. He really didn't need the employees. And actually, when he had to go back and revamp his employee list, he had to apologize to some employees for hiring them because he should have never hired them and wasted their time. So you just really have to sit with your financial planner and your whoever is important to you as far as structuring your business and structuring your operations, right? Now, this list actually has two applications. Since C corporations might have a tax rate that might exceed an individual tax rate, including being double taxed, many small C corps want to drive corporate income close to zero by paying high salaries, right? So, a lot of people say, well, I'm gonna zero everything out in the business and I'll just pay everybody all the profits. There's a strategy, and that's an issue, but there's a strategy to not go down that road. Now, I talked about your children earlier, but here's where we're going to create that strategy for your children. Now, an individual in the United States can earn up to $12,000 of income and not pay federal income tax on those earnings. If you're hiring a child that is under the age of 18 and that child doesn't have any other job and you pay this child up to $12,000, you can take that as a write-off, right? I've been doing this, I can't even remember how long. I've been doing this because my kids used to hand out a marketing material for me to their teachers. And I learned about this particular deduction a long time ago. And I have been taking this for a long time. Of course, I can now, they're 20 and 23. But this is a great opportunity to not only teach your kids entrepreneurship, teach them about confidence, teach them about whatever it is that you want to teach them about, or even train them in the business because, maybe you want to hand it off to them. A great opportunity for you financially as well as for them to learn. Now, your child doesn't have to pay taxes on $12,000, like I said before, from the SCorp, right? Of income earned from the SCorp. They do not have to pay taxes from the SCorp, income earned from your SCorp. Now, with an SCorp, it doesn't matter if your child is under or over the age of 18. You would pay FICA taxes on your child's payroll, but because remember, let's go back. The reason why, one of the main reasons why most people change to SCorp is to identify themselves as a W-2 employee. That's why it doesn't matter if your child is 18 or older being hired in your SCorp, because you're a W-2. Hire your children to be a W-2. Like my children, well, my son is not in my business, but my daughter, she's 23 years old. Well, she will be 23 this month. She's been working for me since she was 18, actually. But I don't have to change anything, unlike with, when we were LLC, right? Because she's not, because she's over 18 and things of that sort. So with an SCorp, it doesn't matter how old your child is, okay? Now, let's say that you're renting your home to your business. Now, this is a concept that I have tried to get people to understand, that you have to separate yourself from your real estate and your business. That's 3 different entities right there. If you have real estate, your business, and you, that's 3 different entities that you need to separate in your head. The IRS allows a business owner to rent their primary residence or a vacation home to their business for up to 14 non-consecutive days each year. The resident can be located anywhere in the United States, and the income is excluded from taxable income for the residence owner. If you didn't know that, screenshot this slide so that you'll have it. If you did not know that you can rent your home to your business, screenshot that slide. And then also at the end, make sure that you fill out the form so that we can talk about it and make sure you get it right. Okay. Now, as an S-Corp owner, you can rent your home to your business for board meetings, strategy meetings for employees. You can basically pay rent to yourself for renting your home from the business. This will be a tax deduction to your business, and you will not have to pay taxes on this rental income. Like I said, 3 entities is you, the business, and the property. And you have to look at it in that way. If you are a, and I'm gonna touch on this because I know he's on here. If you are a real estate investor, you should have a management company or a consulting company. Of course, you have yourself, you represent the 1040. Your management company represents your Schedule C, right? Also, what represents your Schedule C is that K1 from your S-Corp, okay? Because you can pay yourself a salary or a salary for managing the entity. But also, if you're renting your home for board meetings or for strategy meetings, you know, I have strategy meetings all the time. All right. A strategy meeting is you talking to your other person or whomever. If you're on the phone, you're talking to whomever you need to talk to organize your business, and you're in the space of your home, right? So the rental is established with a lease agreement. Now, this is important because this is an S-Corp we're talking about. You have to have the rental is established with a lease agreement between the business and residence owner. Look, I was just thinking about her and she just joined us. Wow. The rental is established with a lease agreement between the business and resident owner with pricing supported by researching and documenting comparable space for a similar event. Like I said, if you have a home, of course you do, you can rent your home to your business. As an S-Corp owner, you can rent your home for board meetings, strategy meetings, employee strategy meetings, or whatever. All right. All right. I just wanted to keep reiterating that and drive that in. So screenshot that if you need to. All right. Now we're talking about asset protection, and then we're almost done. Let's see, we have a question. If you do the rent your home option, can you still do the home? Yes, you can still do the home office deduction because that's on your Schedule C. That's on your Schedule C. Because remember, like the home office deduction, you don't need a lease agreement for that. But for what, let me go back to that slide. But for this one, you do need a lease agreement.
I know y'all see my signal light, bunch of effing mental patients.
Somebody talking about their signal lights. Mute yourself. It's okay. All right. So as an S-Corp, where is it at the bottom? The rental is established with a lease agreement between the business and resident owner, excuse me, with pricing supported by research. So basically you can't, you know, charge yourself unreasonable, that's that reasonable word again, unreasonable prices to rent your own home. You know, it has to be reasonable. So you have to make sure you look it up, you know, maybe even do some comps or whatever in the area. And just make sure you're renting to yourself at a reasonable amount. But it does have to be established with a lease agreement. And you can find lease agreements on Google, so yeah, so this part, you do have to have that. That's the only difference. And then of course, where it's located on the tax form, where you put that number is different from the home deduction. All right, good question. All right, so asset protection. What is asset protection? Now, usually most people, I don't know what people think, or when I say asset protection, because I talk about this a lot, but I really don't connect with individuals unless they already have an understanding of asset protection because they've gone through something. We have some individual who've gone through situations where family members are fighting over a deceased loved one's assets, and now they're talking about, now you're aware. But we want to be proactive in making sure that you're taking care of that now to mitigate those challenges, because you don't want, you protect it from creditors. That's what, typically most CPAs and accountants are talking, and lawyers are talking about, protecting it from creditors. But you have to protect it from some family members as well, because everybody has that litigious family member who just will sue everybody, everybody and anybody, just to get a blanket, just to get a blanket that grandma made. So asset protection is the concept of and strategies for guarding one's wealth. Asset protection is a type of financial planning intended to protect one's assets from creditor claims. Individuals and business entities use asset protection techniques to limit creditors' access to certain viable assets while operating within the bounds of debtor-creditor law. In some cases, this protection is put in place for litigious family members who like to sue each other after a death in the family, like I mentioned before. Now, I'm going to give you an example. I had a client maybe 2 years ago. They were located actually in Katy, Texas. Cypress. They were in Cypress, like 15 minutes up the road. They had a number of properties. I forgot the type of business she had, but the business was generating well over $1 million. It was her and her husband. They had multiple properties. They had a ranch. They had, I think, at least about 4 or 5 other properties. And guess what? All of that was under their name. All of that was under their name. It wasn't even under a business entity. It was under their name. So, you really want to, learn how to protect your assets. It's a great thing to acquire assets, but as you acquire them, focus on protection each time you acquire them. Because if you focus on the protection while you're acquiring them, you won't have to go back and just kind of, do an overhaul on all of your assets, because that can be pricey, so you want to do it, as you are getting the assets. So what is it? Legal strategies used to protect assets from creditors. We said that. Why is it necessary? Many viable assets are left exposed. We said that. What strategies are used? Many limited partnerships, right? Offshore trusts. Now, we're just getting into offshore trusts. I was talking to one of our partner attorneys. She's actually partnered with JA, and we were talking about some offshore trusts that a client was interested in having. So I'm excited about getting into that coming up in the next few weeks. Bridge trust and more. Now with trust, you have, irrevocable and you have revocable. Most people call them land trusts. I heard from an attorney that is not a thing. That's just a layman's term, but it's not the official terminology. The official terminology is irrevocable trust. So also, who needs asset protection? Everybody, everybody. You may say, well, I don't own any land. I don't own any cars. I don't own a house. Do you have a bank with cash in it? If you have a bank with cash in it, you need to protect your assets in some kind of way. Now, depending on what you have, depends on what you need to protect and how you need to protect it. Intellectual property in your business. If you create, like in JA, we create programs, we create systems, we create. So we have intellectual property that we protect each time we create it. The RP3 system, we're literally waiting on the trademark from that. We're trademarked that system. So like I said before, as you are creating or as you acquire assets, you want to make sure that you are protecting those assets from creditors, and then also, like I say here, vultures. Now, here are the common asset protection strategies. Understand what your assets are in order to protect them. Now, LLCs can protect wills and trusts, insurance, copyright, trademark. I just mentioned trademark. In my industry, you know, I come from the education background. I started trademarking and copywriting my work even when I was teaching before I got my first office, because I realized that I was giving away intellectual property to my boss. You know, I was like, I would create activities, lessons, and things of that sort. And I was like, wait a minute, I created this. And, you know, because I was understanding business at the time. And I was like, I started copywriting everything. And then they started seeing the circle, you know, the C at the bottom and the year and all that. They started seeing it. They asked me questions, well, what is that? I was like, that's a copyright. That means that you can't copy it unless I give you permission. That's what that means. So yeah, you want to make sure that if, you know, you have intellectual property, if you have other assets, you want to make sure you're protecting them. Now with LLCs and real estate, there's a strategy in protecting your property, but it's a stackable asset protection where you have your SCorp at the top, and then you have your LLCs that are designated for each property that you purchase. So for example, if I purchase a residential home and I rent it out, I'm going to protect that under an LLC, but guess what else I'm going to do? I'm going to also protect it with a trust, because I'm going to be the trustee who manages the trust. So I'm protecting my property that's listed under my LLC from the creditors who will come after me in my name, right? Because that's added protection. The LLC does not protect your property by itself. My advice is to always get a trust and you get a trust with each property that you purchase. You get an LLC with each property that you purchase, especially if you're doing rentals, because if you're doing rentals, you are very susceptible to lawsuits. Renters will sue you for any little thing, and you don't want that to spill over into your business. And then compromise all of your other assets. Now, there's a reason the demand for assets protection is growing. People sue each other even more now. Especially in the South, in the Midwest, people are increasingly willing to take each other to court all day. Because guess what? It only costs $250. And if I'm mad enough, I'm going to take you to court. I may not win, but I'm going to take you to court just so I have it on record, because some people are just petty like that. You know, it may not be anything, but then it may be something big. They may not be being petty, but it's only $250 to file. So all the more reason why you definitely have to protect yourself. Now, here's some SCorp examples. An overloaded SCorp versus a properly structured SCorp. Did I skip? No, I didn't skip. Okay. An overloaded SCorp, and I just mentioned this, has 3 real estate properties. You know, they're all rentals, intellectual property from creating curriculum software or technological systems, that's overloaded, right? Because that's all under the SCorp. Now, this is also if you just haven't, if you're not an SCorp and you have an LLC and you still have all of these things, you're still overloaded. You know, you still need to protect your assets properly. On the right side, properly structured SCorp. All real estate properties are under a different LLC. The SCorp is used to manage the LLCs. Each LLC and the SCorp has its own trust. You cannot forget about the trust. You must remember about the trust. When the corporation sells goods or services other than professional services, liability for these activities will usually be limited to the corporation. Okay. A buyer of goods, like if you buy goods, as opposed to being a seller, typically that doesn't require a personal guarantee as the quality of the product. As to the quality of the product. If your product is faulty or someone is injured by the product, the corporation will be liable, but not the principals, not you. The corporation will be liable. If a corporation supplies services, right, such as a contracting or repair work in a house, only the corporation will be liable for faulty services. A corporation provides a useful shield against personal liability in connection with the sale of products or services. When a corporation buys goods or services, liability for payment will also be limited to the corporation unless the principals have signed a personal guarantee of the obligation. Also, going back to something I shared, I was on Jessica Lee Financials. Well, Jessica Lee is her name. I was on her live Zoom the other day, and I was actually talking about asset protection in a way, but I was talking about non-recourse. Non-recourse, like on the lending side, you know, we have non-recourse loans. Those non-recourse loans serve in a similar capacity to where if you default on a non-recourse loan, the entity is responsible, not you, the individual, which is a beautiful thing because you don't want that on your personal when you're actually growing a business, you know, but, you know, of course you don't want to default anyway, but that's just another example of what I was just sharing about goods and services and then the principals not being liable. All right. So corporations protect you from liability. However, you do have to continue with the protection. And like I said before, getting a trust and being the trustee or the manager of it is the safest way to protect yourself. All right. Your liquid assets, your cash, protecting your liquid assets using your SCorp status, eliminating double taxation. We talked about that. I won't get into that. Adding protections for your SCorp. If you are a principal, shareholder, or officer, director of a corporation, use a proper asset protection plan to shield your personal assets from the potential liability associated with the corporation. And if you want an asset protection plan created just for you, you can get that done. Micaiah is actually going to put a link in the chat at the end, which we're very close to, and then you could just submit your information so that we can schedule a time so we can create your asset protection plan. But in order to qualify, you know, for this, you know, protecting your liquid assets, the stock of an SCorp must be held by 75 or fewer individuals and all shareholders. Basically, you can't have no more than 75 people who you have as shareholders, you know, for this added protection. All right. So I think that, you know, most of us are okay on this part, but an S corporation has all of the lawsuit protection features of its C Corp as well. If unreasonable compensation, however, remember we talked about reasonable compensation. If you have unreasonable compensation, that would be an issue, or the corporation is expected to show net losses. right? So it gets deep. It really does get deep. But going back to what I was saying about the reasonable compensation, just make sure that you are compensating yourself based on what the industry says, and then also what your position dictates, all right? Now, the whole idea of this presentation is to talk about your graduation. When do you graduate? Do you have a DBA? Do you need to graduate to an LLC? If you do, look at your business model, products, services, operations, etc., right? And you do the same thing also if you're going from an LLC to SCorp, but you're also identifying what assets that you have, what assets that need protecting. Sometimes we have assets in our business and we don't even know, we don't consider them as assets. So that's why it's good to, bounce things off of another person who may see things differently than what you see them, so that we can clearly identify your assets. When you're moving from an SCorp, when you graduate rather, from SCorp and LLC asset protection, categorize your assets. That'll help. Like if you say, okay, let me start with my liquid assets. How many bank accounts do I have and how much money do I have in them? And this is just a personal categorization, right? And then you list, okay, real properties. How many properties do I have? And just make sure that you have everything covered. So categorize your assets if you have an SCorp and an LLC, and just to make sure you protect them. And lastly, reasonable salary. Make sure that you understand what your reasonable salary is supposed to be as opposed to what you chose it to be. Schedule a consultation to determine a specific reasonable salary, okay? Now, with that being said, the next step for you is to, first of all, we have a business structure wizard. It's free. I want you to try to go on our website. It's on our website, but it's on the tax filing services page. Go on that page and fill out the business structure wizard. Also, Micaiah is going to put that link. She's going to put 2 links, Micaiah. She's going to put 2 links in here. I think she just put, okay, yeah. Go ahead and put the other link in here as well, Micaiah. The link that she just put in here, that is the deliverable link. That link, if you fill that out, I will be able to send you the deliverables, the fact sheet, the IRS fact sheets that I told you that I would send you. I'll send you that so that you'll have that to guide you as well. Because a lot of these things is just really about you understanding your business and understanding how to graduate and how to manage yourself after graduation. And remember, graduation is all about, it's not just an event, it's a matriculation from one level to the next, right? So fill out the form, the Let's Talk form, fill that out. Also, I hope she heard me, Micaiah, put that other link for the business structure wizard. That's also in our Cognito form. Just you could go in Cognito and just copy that and put that in there. I'm throwing something on her at the last minute. But also join us on August 17th and the 24th. We will have our next SCorp Playbook webinar. Our next SCorp Play. So that's going to be August 17th and the 24th. Next week, we will be we will be on vacation starting tomorrow, actually. So we won't do it next Tuesday, but we'll do it the following Tuesday. But if you need anything, if you need a consultation, I'm definitely going to be available this week, and we'll have some other individuals that'll be available this week as well. So with that, if you have any questions, go ahead and put them in the chat and I'll be glad to answer those questions. And Micaiah, go ahead and put that link in there. Let me see. Yeah, go ahead and put that link in there to the wizard, the business structure wizard. Wonderful, thank you. You're awesome. You're awesome. All right. So make sure you copy and paste, or even you can save the chat in this presentation. Make sure you copy and paste those links. If you don't, if you're not able to click on them, well, if you're not able to save them, then click on them and then you'll already have it in your browser. All right. All right. So I want to give y'all time to go ahead and copy it or whatever. But like I said, if you have any questions, put it in the chat. But right now, I'm just waiting on you guys to make sure you have those forms. And again, man, I appreciate you, your attendance. I appreciate your attention. And anything that I can do to help you to either understand this process of SCorp filing or SCorp designation, I'm here for you. All right. So hopefully you also learned a lot about what we do outside of the things that we probably provide for you as a business owner. Thank you. Thank you, Ronique. I appreciate you. Thank you, Carla. Love you, Carla. Love you, girl. And great. I thank you. Thank you all. All right. So if you already have that information, let's see, I would like to have a one-on-one. Oh, absolutely, Letitia. Letitia, you know what? What time is it? I can call you after this. Okay. I can call you after this. All right. Because
sounds great.
Beautiful, beautiful. All right. So with that being said, hopefully everybody has the link. And again, y'all have a beautiful rest of your evening. And I look forward to working with all of you and doing my best to support what you're doing in your businesses.